Hello, students. Students, here we are now. We'll be now looking into the certain practical part of the international taxation. Now, those students primarily there are certain capital gains implication that is also being there. So if they are looking the lectures in the sequence, if they do want to also refer before these lectures further the capital gains topics, they can view the capital gains topics. It is up to all to them, or else they can follow the sequence. Now, students, one thing which is there in your, I have been like the last 2 days was highly occupied with this entire research which went across to the entire MTPs that has been released by the ICI, the 6 MTPs plus the RTPs, as well as suggested answers and all. And I will comfortably can say, students, that your final practice, the MTPs are so comprehensive, as well as if you also supplement the same with the RTPs as well. So that becomes so comprehensive that primarily it will take across primarily your entire scenario of your syllabus with the practical approach. Good context of the questions has been added in this regard. So I am just changing the twist in this particular case. I would be involving more because I've been comparing the ICS study mat as well as your MTPs and all, and I found the fact that the question which are being put up in the MTPs or maybe in the RTPs as well, in some of the questions of the RTPs also I've marked it. I found them to be of a high order as compared to what has been given to you in the study material. In fact, the way the questions are being targeted in your examinations are primarily based on these MTPs and the RTPs. So what we will do, students, now henceforth would be this, that completing these 6 MTPs primarily topic wise. Obviously, students, I have made the list of the same. Primarily, the thing is that I have to, in fact, take a jotting down of all the chapter-wise this thing. The MTPs are not in the sequence of the chapter-wise. They have been given as a paper itself. So, in that scenario, students, I have taken those things particular topic-wise, and we will be solving the questions of the relevant MTPs as and when we are going to address the situation. Now, in the previous particular class, students, you already have learned in the context of an indirect transfer. The indirect transfer where a foreign company which derive its own value substantially, the foreign company is deriving its own value substantially from an Indian asset. In that particular case, the shares of that foreign company is deemed to be situated in India. If a foreign company is deriving its own value substantially from an Indian asset, then the shares of that foreign company is deemed to be situated in India. Now, therefore, the question is that how will be the foreign company will be deriving its own value substantially from an Indian asset? And the second question that arises is when this test needs to be applied, on which date the test has to be applied. So there are two questions that needs to be answered. One, how the foreign company will derive its own value substantially from the Indian asset. That is question number one. And the second question is when this test has to be applied. So let's look upon to the question which we have formulated. Revise this thing. Question number one. How the foreign company derive its own value substantially from the Indian asset. The test is that the fair market value of the investment made by this foreign company in the Indian asset, the fair market value of the foreign company, the fair market value of the investment in the Indian asset made by the foreign company is more than rupees 10 crores. Repeat with me, students. The fair market value of the investment in the Indian asset made by the foreign company is more than rupees 10 crores. And the second one, both these conditions have to be satisfied. The second one is the investment in the Indian asset. The investment in the Indian asset, the fair market value of the investment in the Indian asset. The fair market value of the investment in the Indian asset should be more than or equal to 50% of the total fair market value of the asset of the foreign company. The total fair market value of the asset of the foreign company. These are the two tests. So the fair market value of the investment in the Indian asset should be more than 10 crores. More than 10 crores. So it's not greater than or equal to 10 crores. More than 10 crores. And the second particular test is the fair market value of the investment in the Indian asset should be at least 50% of the total fair market value of all the asset of the foreign company. This is a test. Now the question is that what is the fair market value? So the fair market value that they have mentioned is that it should be aggregate value of, it is a fair market value of all the assets without reducing the liabilities. So without reducing the liabilities, you have to take the fair market value of all the assets. That is it. Now you will say, sir, how to calculate the fair market value? Leave it. They will not ask you this question. There are rules for that same. Rule 11UB. But you don't have to get into the rules particular part of it. They will not target on this context. Yes. In capital gains slump sale, you have to know the rule of how to compute those fair market values and all. Here it is not required. In black money chapter, also there is a fair market valuation rules that also needs to be known to you. So two particular cases where the fair market value is something that you need to know. You need to take a note of it. You can take a note of it. The two cases where the fair market value needs to be learned by the students is, one is the slump sale in capital gains, and second is the fair market valuation in the black money chapter. That is it. But here for indirect transfer, you just need to remember that the fair market value of the investments or the fair market value is the fair market value without reduction of the liabilities. Fair market value of all the assets without reduction of the liabilities. Is that point clear to all of you students? Perfect. So this is a test primarily of determining how do we ascertain that the foreign company is deriving its own value substantially from the Indian asset. Now the second, what was the second question? The second question was when this test has to be applied. So the relevant date when this test has to be applied. They have given you two dates. They have given you the two dates. The two dates are date number one, the date when the shares of this foreign company has been transferred by the shareholder. So definitely in this foreign company, I am the shareholder. So the date when I have sold the shares of this foreign company, yes, not the Indian asset. The date when I have transferred the shares of that foreign company. Either I can take up that date for the purpose of determining what? Determining the test whether the foreign company derive its own value substantially from the Indian asset. So either I take up that date or there is a second date also. Which is the second date? The last date of the accounting period. The last date of the accounting period preceding the date of transfer. So what is the last date of the accounting period preceding the date of transfer? So say for example, I have transferred the shares of that foreign company in the month of July 2025. And the accounting period has ended in last December. The last accounting period which has ended is last December. So therefore the second date is 31st December 2024. So July 2025, say 15th July 2025 and 31st December 2024. Now there are two dates therefore to be considered. Question therefore is which date I am going to take into account. So to decide the date between the two, I need to check out the total book value. Here not the fair market value, but the total book value of all the asset of the foreign company on these two dates. That is the last date of the accounting period preceding the date of transfer and the date of transfer on these two dates. What is the total book value of all the asset? All the asset, not the Indian asset, all the asset. Check the total book value of all the asset in these 2 days. And if the total book value has increased by more than 15%, if it is increased by more than 15%, then the relevant date on which the test would be applied would be the date of transfer. The relevant date on which the test would be applied would be the date of transfer. But if you say, sir, it has not, in fact, has increased. It has not increased by more than 15%, students, in this context. Then what do you say? In this scenario, you say, sir, it is not more than 15%. Then what is the answer? Then in that particular case, students, the relevant date on which the test would be applied would be the last date of the accounting period preceding the date of transfer. The last date of the accounting period preceding the date of transfer. So if it has increased by more than 15%, you take the date of transfer. If it has not increased by more than 15%, you will take up the last date of the accounting period preceding the date of transfer. Is that point clear to all of you, students? Every one of you? And that exactly is the point. So on that basis now, students, there is this question. You can just, I think one question already you have solved in this particular previous thing, in this regard, the previous class. One question we are now taking into account of the MTP, which is in page number 31. So you can just write in your notebook page 31 of the MTP. Let's have a look, students, in this context. XYZ company, an Indian company, is engaged in the business of manufacture of packing material, having its manufacturing facility in India. So XYZ company, an Indian company, is engaged in the business of manufacture of packing material, having its manufacturing facility in India. So that is point number one. So this is an Indian company. XYZ company is a wholly owned subsidiary of Flix Inc. So this is a wholly owned subsidiary of a foreign company. Now, obviously, your mind should now think very critically on this statement in the question in the examination, that whether this foreign company derive its own value substantially from the Indian company. So whether Flix Inc. derive its own value substantially from XYZ and company. If yes, then the shares of Flix company will be deemed to be situated in India. Let's go further. In this case, the XYZ company is a wholly owned subsidiary of Flix Inc. A company incorporated in country M. Angelo and James, citizen and resident of country N. Each of them hold 50% of shares of capital of Flix Inc. So I told you in my example, I was a shareholder of that foreign company. I have done the transfer of the shares of the foreign company. So similarly, there is two shareholders of that Flix Inc. Each holding 50% each. In this context, that is what they've said, and they happen to be non-resident because they are situated where in country N. These two shareholders are non-resident in India. Angelo and James each had invested equivalent of 100 crores or in Flix Inc. in April 2015. So that is their cost of acquisition. Okay, so that is their cost of acquisition of the shares. On 1st of June 2024. Angelo and James, having received an offer which they believe was fair, sold their entire stake in Flix Inc. to Ishan, resident of country N, for amount equivalent to INR 350 crores each. So what is the date of transfer, students? The date of transfer of the shares is 1st June 2024. That becomes the date of transfer, students, in this context, isn't it? Now, you have been given the accounting period. Now, I told you for relevant date, you have to select the two dates. For the relevant period, you have to select what? The two dates. Which are those two dates? Date number 1 happens to be the date of transfer. What is the date of transfer? 1st June 2024. Now, in this table, you have given two more dates. Can you tell me which is the second date you are going to select for the purpose of making comparison? Comparison for what? For determining the relevant date. Which is the second date that you are going to take? Bank. 1st June 2024 is the date of transfer. Which is the second date in this table that you are going to take? Quickly. Indeed. And the second date has to be the last date of the accounting period preceding the date of transfer. The last date of the accounting period preceding the date of transfer. Therefore, it becomes what? 31st December 2023. So therefore, the two dates that you're going to select would be 31st December 2023 and the second one would be 1st June 2024. So if I have to select the relevant date, on which date we have to see? What I told you, you have to check the book value of the total asset of that foreign company as on these 2 dates. The book value. So book value of the assets, can you just see book value of the assets? The first line itself. The first line itself. As on 31st March 2023, how much it is? 1000 crore. As on 1st June 2024, it is 1300 crores. So how much is the increment? 300 crores. And therefore, is it more than 15%? Answer is yes. So if the answer is yes, what is the relevant date on which you will make the application of the test? The relevant date happens to be 1st June 2024. Now, therefore, on 1st June 2024, you have to check two things. Which are the two things? Point number one, that whether on 1st June 2024, the fair market value of the investment in that Indian company, XYZ company, is it more than 10 crores? That is point number one. And what is point number two? Whether the fair market value of the investment in that Indian company, is it at least 50% of the fair market value of the total asset of that foreign company. So let's have a look. And the fair market value, I told you already. What is fair market value? Fair market value is the fair market value of all the asset without reduction of the liability. So just have a look over here. The fair market value of the asset, see what they've written, without reduction of liabilities. It is going in the next page. So therefore, in that particular context, what is the fair market value of the assets without reduction? So it is 1100 crores. 1100 crores, students. As on 1st of June 2024. That is the relevant date. So you have to focus only now on 1st June 2024. Now, check out on that date. What is the fair market value of the investment in the Indian company? So just have a look, students, the last particular this thing. The last row. Last row. Fair market value. Fair market value of the asset in the balance sheet of XYZ company without reduction. So the details regarding investment in XYZ company. So you are going to take up the 600 crores. Students, you are going to take up what? The 600 crores. So check out the investment in XYZ company, students. Details of the investment in XYZ company. So the details of the investment in XYZ company, I have to take up the fair market value of the asset of that investment in XYZ company. So therefore, in that situation, students, how much it is? 600 crores. 600 crores vis-a-vis total fair market value of all the asset is how much? 1100 crores. Is it at least 50%? Answer is yes. In fact, more than 50%. So whether both the condition, what is both the condition? Condition number one. Now, what is the first condition? In this case, more than 10 crores. Is it more than 10 crores? Yes, 600 crores. In that context. And the second one, students, is in this context is 1100, which is 50%, is also the criteria which is satisfied. So whether both the condition is satisfied, answer is yes. So can I therefore say that the foreign company Flix Inc. dot derive its own value substantially? That I have already given. Just refer question number 31. Page number 31. Page number 31 I have already mentioned to all of you. So whether, students, whether in this particular case, the fair market, whether the foreign company, can I say foreign company Flix Inc. dot derive its own value substantially from the Indian asset? Answer is yes. Answer is yes. And if the answer is yes, then what we will say, students? What we are going to say? That in that context, since Flix Inc. dot derive its own value substantially from the Indian asset. Therefore, the shares of Flix INC is deemed to be situated in India. And if it is deemed to be situated in India, then tell me, in this case, see the question now. Determine whether the income arising from transfer of shares of Flix company can be chargeable to tax in the hands of Angelo and James. Can it be chargeable to tax? Who is a transferor? Who has transferred the shares of foreign company Flix INC? That to Mr. Angelo and Mr. James. So did they transferred an asset which is situated in India? Answer is yes. Can it therefore be said that the income arising from that transfer, therefore can it be said that the income arising from that transfer is the income which is deemed to accrue rise in India? Answer is yes. Under which section, can I ask you students, under which section it is deemed to accrue rise in India? Under which section, students, it is deemed to accrue rise in India? Under section 911. The first section 911. I hope that all of you are clear with this one. Every one of you. Primary. Now students, this question, primary, and one more question. You will have to solve this. Answer is known to you. You are feeling happy about it? Yeah, sir, I understood the concept. Write it and then tell me. You will be finding it difficult to write this answer. I'm betting on this part. And every student's primary who is primarily giving this particular thing, they will write and share their answer to me in my WhatsApp. I'll just have a look exactly what you people write. Even knowing the answer, you'll fumble to make the presentation. And this question, why I will make you write those questions which I feel is an important one for your examination. Because considering what has been targeted in May 25 attempt, I do understand the dynamics of the examination, exactly what may not be targeted now in the subsequent attempts. And what could be targeted now in the subsequent attempt, this happens to be one among them. Just write it down. And since it is the ICI question itself, primarily, hardly it will take you 15-20 minutes, but it's worth a last time particular practice of this critical question. Coming further, students, now in this particular context. So we are done with this indirect transfer completely in this context. Now, students, taking our discussion further. Taking our discussion, students, further. After this 911, students, this other section which are being there, namely, in this context, the next one, students, happens to be 912 and 913. 912 and 913. Before that, students, there is this concept of, students, be careful. Last particular point I just wanted to, before we complete, significant economic presence. Students, as you generally know, an income, a business income of a non-resident, see, this is a general rule. A business income of a non-resident is deemed to accrue rise in India if the non-resident has got a business connection in India. If the non-resident is having a business connection in India. Question arises, what do you mean by business connection? Now we have seen in this thing, business connection, they have said what it includes and what it excludes. So what it includes, they have given, there is a dependent agent who performs certain function, and because of that dependent agent performing certain function, the non-resident can have a business connection in India. So that is what it includes. Business connection includes something. And what it excludes also, students, there are particular points which have been mentioned to you. These are the exclusions which are being given in this regard. That look, these are the exclusions which are being there, whereby business connection will not include these activities. But what actually it means, they have not mentioned those things. Generally, students, what business connection will mean, just on a layman term, business connection would mean that there is some sort of a physical presence of a non-resident in India. The non-resident has got some sort of a physical presence in India. So whenever a non-resident has some sort of a physical presence in India, we will say that yes, the non-resident has a business connection in India. Some sort of a physical presence. Like for example, branch, factory, depot. These are some of the examples. So if a non-resident is operating through a branch in India, can I say that the non-resident has a business connection in India? And the answer is yes. Question arises that without any physical presence, can a non-resident have a business connection in India? Without having physical presence, can a non-resident have a business connection in India? Generally, the answer is no. However, explanation 2A to 911, which you can see over here, they have said that even if the non-resident may not have any physical presence in India, still there could be a business connection of that non-resident in India. Still, there could be a business connection of that non-resident in India if what? If that non-resident has a significant economic presence in India. If that non-resident has a significant economic presence in India. Now, therefore, question arises. So, therefore, without a physical presence, the NR can have a business connection in India. How that is possible? That is possible if the NR has got a significant economic presence in India. Question therefore is, what do you mean by the term significant economic presence? They've given two tests. Either of one of the tests you can satisfy, and the non-resident can be said to have a significant economic presence in India, and because of that, this will give rise to a business connection in India. So what are those two tests? Point number A, transaction in respect of any goods, services or property carried out by a non-resident with any person in India, including provision of download of data or software in India. So supposingly a non-resident family from its own country, he is doing a transaction of, say, supply of goods. He does not have any physical presence in India, but he is doing a supply of goods from his country to a person in India. To whom? To a person in India. So, what is the value? The question therefore arises, sir, what is the value then? The value should be in excess of 2 crores. In excess of 2 crores. So, the aggregate value of the supply, if it is in excess of rupees 2 crores in the previous year, then yes, the non-resident can be said to have a significant economic presence in India, giving rise to a business connection in India, and accordingly income arising from such business connection will be deemed to accrue or rise in India under 911. I hope that all of you are clear with this. Second particular test which you can see, systematic and continuous soliciting a business activity or engaging in interaction with users in India through digital means. Through digital means. Like for example, students downloading of the app. Now through the app, I've downloaded the app, and therefore in that situation, the non-resident is in a position to interact with the users. So if the number of users, students, the number of users now in that context, if it is at least 3 lakhs, in Netflix, you can say, taken the subscription of Netflix. Now Netflix, accordingly, in that situation, you'll find that if the number of subscriber in India is at least 3 lakhs, then can we therefore say that Netflix is having a significant economic presence in India? Answer is yes. Therefore, can we say that there is a business connection of Netflix in India? Again, the answer is yes. Therefore, the income arising from that business connection, can it be said to be an income deemed to accrue or rise in India under 911? Answer is yes. I hope that all of you are clear with this one. This is an important particular part, students, because what has happened now, students, as you may be aware, equalization levy, there are 2 sections of equalization levy. There were 2 sections of equalization levy. Now, as you all are aware, students, one section is gone. 165A is out. Only the original section, the Google tax, is only that is left. In fact, that Google tax is also out from the next AY 26-27. The first original section 165 is also out from the race. So you can just imagine the equalization levy is deleted completely. But for your attempt, family, only 165 is there. 165A is out from the race. So therefore, that is diluted. with that being diluted, this becomes a very prominent factor, it's a significant economic presence. So again, there could be a possibility of some MCQs or something of the order which we cannot foresee right now could be there from this side. That is something, therefore I'm making a special emphasis with all of you on this regard. Coming back, students, now the next section, coming to this one, 912 and 913. 912 and 913, students, in this context, which is being there over here. This is about the salary income. Now, salary income, students, which you know, when a salary income is deemed to accrue as in India, that is the question. When a salary income is deemed to arise in India, it's a very simple thing. The salary income, students, will be deemed to accrue as in India if it is earned in India, if salary is earned in India. No one can say, sir, when the salary is earned in India. Salary is earned in India, they've given you two cases. Case number one, if you have rendered a services in India, if the employee has rendered the service in India, in that context, if the employee has rendered the services in India, then yes, the salary income of that non-resident is deemed to accrue or rise in India. In this regard, fine. There is one more particular point which are being there over here, students, which is if immediately before the service period, or immediately after the service period, either immediately before the service period or immediately after the service period, if that non-resident employee is getting a paid leave, and that is a paid leave, then even that paid leave being a salary will be considered as an income deemed to accrue or rise in India to that non-resident employee under section 912. Under section 912. Yes. And that exactly is the point over here. Now, in this salary income, student, there are only two things which are being there that you just be very careful about it. Only two concepts are there. Only two concepts, students, that you should just pay attention towards it. Which are those two concepts? One concept, students, is the short stay exemption. Now, you will find that many of these employees are coming in India. Many employees keep coming in India. Foreign companies employees keep coming in India. They stay for say 10 days, 12 days, and they move out. Now, if for 10 days and 12 days of stay, if supposingly the chargeability has to be attracted, then don't you think that it is very unreasonable and unjustful that you will say, sir, 912, whether the income is deemed to accrue as in India? Yes. Because they have said that if you have rendered the services in India, so whatever is salary which is attributable to such rendering of service in India, that portion of salary would be deemed to accrue as in India. One can definitely say that. And if it is accordingly getting accrued in India, whether it will be charged to tax in India, and the answer is yes. And the answer is yes. So therefore, the question over here is that this question of short stay exemption, students, is an important particular part. Now, what is this short stay exemption, students? 1066 is giving you a case of a short stay exemption. 1066 is giving you a concept of a short stay exemption. I just want all of you to just run through this 1066 quickly, students. They have targeted this particular part in one of the examination, bold attempt. So students, just emphasis upon in the examination question which I'm talking about it, that I was just talking to all of you on that examination question, students. So over here, students, if you see very carefully, the examination, I don't know whether you have solved it or not. Some Mr. Norman or something of that sort, Mr. Norman, a employee of some foreign company, he came in India and he was staying in India, I think for some 80 days. Have you solved that kind of a question, old attempt question? If not, then I will just share you that particular question. Obviously, they may not repeat that same question, but you just need to know primarily. Okay, so I'll just share with you that question also in that context. So over here, if you see, if an employee, students, be careful, if an employee doesn't have an aggregate stay of more than 90 days, that is important, students. If the employee does not have the aggregate stay of more than 90 days, that is point number B, and also point number A. 2 points, students, you just remember it. Third point, leave it. A and B, just remember these 2 points. If the aggregate stay of that foreign employee is not exceeding more than 90 days. And what is point number A? Foreign enterprise is not engaged in any trade or business in India. Means the foreign company of which this particular person is the employee, the foreign company of which this particular person is an employee. What I have told you, students, in this context? What I have told you in this particular context? That in this particular case, that foreign company should not be doing any trade or business in India. Any trade or business in India. So therefore, students, therefore, if these conditions are satisfied, the aggregate stay of the employee is not more than 90 days, and that foreign company of which that person is the employee, that foreign company should not be doing any trade or business in India. If both the conditions, students, is satisfied, if both the conditions, students, is satisfied, what we are going to say? What we'll say? If both the conditions, students, are satisfied, then what we are going to say? Indeed. Then whether the short stay exemption, students, will it be applicable under 1066? Answer is yes. The short stay exemption, students, will be applicable under section 10.6. Is that point clear to all of you? This is what it is, students, in this regard, and that exactly what this 10.66 is all about. Okay? So therefore, read the question carefully. If you find a question where they say this is an employee of a foreign company and therefore his stay in India was for this many days, check out whether 10.66 is applicable or not. So whenever you do salary 912, students, just write next to that short stay exemption of 10.66 has to be seen. I hope that all of you are clear with this one. That is point number 1. So students, apart from that, just can you read this one? This is for diplomats and all. This I found in some MCQs earlier. Although they have not targeted, but ICI has got certain MCQs in this. Just can you read this particular part? Say you find the foreign employee who are like a diplomat's embassy office. In that case, who are the diplomats working in the embassies in India? About them, students, 1062, please have a look once over here. Just read this one out. So over here, students, only one thing you should just keep in mind. This is only for a plain MCQ, students. Apart from MCQ, you will not get any questions on this. If at all they have to target anything. So students, the condition is this, that in this particular context, the individual students who is receiving should not be a citizen of India. Because in the embassies, now students, just think logically, in the embassy, foreign embassy, you will not find that all the embassies are the US staff in US embassy. Definitely they will also have some of the Indian staff also. Indian staff as well, students, in this regard. In this regard, students, will you find an Indian embassy students or not in this contest? Yeah, Indian staff or not? Yes. So whether the Indian staff or not, they are also getting the salary from the US government, the Indian staff who is working in the embassies in India. So whether the salary received by those Indian staff, will they also qualify for exemption under 1062? Answer is no. Why? They are a citizen of India. So to claim an exemption under 1062, what is to be seen very carefully, that a person who is getting this amount should not be a citizen of India. Is that point clear to all of you? Fine, students, that's exactly the point. Now, students, the second issue, this was just to read this one out. This is not that important. The important one was the short stay exemption. That is the first issue that you should remember in salary income of a non-resident. The second issue, students, that you should be very, very careful about it is about what? Is about the fact, one question will come in your TDS chapter, but I'm just doing it here right now with all of you, so that when you go through the TDS also, you will have a vivid memory. Students, salary income TDS is deducted under section 192. For salary income, the TDS is deducted under section 192. All of you are aware of it. Perfect. So let me give a particular case study on this particular part, wherein this non-resident employee is in India. He is working with an Indian client. So the foreign company has put him for some projects in India. For that project in India, the Indian client who is there, he is placed with him for some days, and assume that it is more than 90 days. So this 1066 is not applicable. The short stay exemption is not applicable. Now, as per the agreement between that foreign company and the Indian client, as per the agreement between the foreign company and the Indian client, what is the agreement between the two? The agreement between the two is that the Indian client will be giving a particular, the Indian client will be giving daily allowance to the employee of the foreign company. Daily allowance. To whom? To the employee of the foreign company. Okay. Question is this. The Indian client, which is giving daily allowance to the employee of the foreign company, whether these Indian clients, will they be liable to deduct TDS under section 192? Whether they will be liable to deduct TDS under which section? Under section 192 is a question to all of you. Tell me, students. Will they be required to deduct the TDS under section 192 in this regard? So many of you are suggesting the fact that, sir, for TDS under 192, we see that the employer is the one who deduct TDS under 192 when they pay a salary to the employee. So is it that 192 obligates the deduction of TDS only on the employer or to any person? Whether 192 obligates the deduction of TDS only on the employer or to any person. 192. Not talking about other section, 192. Be careful, students, over here. 192 does not focuses upon who is the payer. Payer can be any person. What 192 emphasizes upon is whether the person who is receiving the amount, that recipient, in their hands, the amount should be chargeable under the head salary. The recipient, in their hands, the amount should be chargeable under the head salary. That is the only requirement. So now you have to see the daily allowance which the non-resident employee is getting. Getting from whom? From their employer or from the Indian client? Indian client. Now whether that daily allowance that they have received from the Indian client, in their hands, in the employee's hands, whether they will be charged under the head salary or some other heads of income. The answer is under the head salary. And why it will be chargeable under the head salary? Because this amount was received to them in the course of their employment with the foreign company. The amount they have received, did they receive this amount on their own independent contract, or they have received the amount in the course of their employment with the foreign company? They have received the amount in the course of their employment with the foreign company, and that is the reason why this particular amount will be charged in their hands under the head salary. And if it is chargeable in their hands under the head salary, then irrespective whosoever may be the payer of the amount, that payer would be under the obligation to deduct the TDS under section 190. So what is the second issue over here, students? Non-resident employee receiving an amount, in the course of their employment from any person. The non-resident employee receiving the amount in the course of their employment from any person, then that person would be under the obligation to deduct the TDS under section 192. That person would be under the obligation to deduct the TDS under section 192. I hope that all of you are clear with this. Every one of you, students? Perfect. Now, friends, let's look upon to this particular part of 914, the dividend income. Now, this independently you don't get it. I'm just quickly recapping this because there are practical questions which are going to come now. Family, be very careful. And one of the questions is there already in your RTP, MTPs, which I have already marked it. So therefore, let's quickly recap. A non-resident is earning a dividend income. So when a dividend income will be deemed to accrue rise in India for a non-resident? When a dividend income will be deemed to accrue rise in India for a non-resident? See 914 what it says. If that non-resident has received a dividend income from an Indian company, that is the only criteria. Students, that is the only criteria. So if that non-resident has received a dividend income from the Indian company, then in that situation, the dividend income, will it be deemed to accrue rise in India? Answer is yes. Answer is yes. That exactly is the point, students. That exactly is the point. So friends, this is how the things has to be looked upon so far as 914 is concerned in this context. Okay. Now, this is an important one and this will be targeted in your practical question. Students, interest income, royalty income and the fees for technical service income. These are the three incomes. Interest, royalty and FTS income. Question is, when the income is deemed to accrue rise in India to a non-resident? There are in fact two things that you should be careful. One is when the income would be deemed to accrue rise in India. Either this could be one of the question, or the second question would be what is the tax rate for these income. And in the practical question of computation of total income of a non-resident, okay, computation of total income of a non-resident, you will definitely find not only total income, tax liability also. You will definitely find these elements. So when they ask you a total income question and tax liability question of a non-resident, then definitely you will find the elements of dividend income, interest income, royalty income and FTS income. For that, you should also know what is the applicable tax rates on these income earned by the non-resident, because only then you will be in a position to compute the total income and thereby compute the tax liability. The second part of the question is not a practical one. The second part of the question that you get in the examination is more like a case study, where they will ask you whether these income is deemed to accrue as in India. Interest income, royalty income or FTS income. That is what they will target. And therefore, to understand whether these income is deemed to accrue as in India, primarily just read this chart. Now in this chart, students, here we have given who is the payee. Payee means the receiver. Receiver definitely is a non-resident. But who is the payer? Now students, here the payer can be any person. Like the payer can be government, resident or a non-resident. The payer can be any person. You have to check the payer who is making the payment. What is the purpose for which they are making the payment? What is the purpose for which they are making the payment? The payer who is making the payment is made to whom? To non-resident. What is the nature of payment? The nature of payment is either the interest, payment in the nature of interest, payment in the nature of royalty, payment in the nature of FTS. What is the question that you need to answer? The question that you need to answer is primarily that what is the purpose for which that the payer is making the payment to this non-resident. So the purpose is, students, take into account the purpose herein. If the purpose of the payment, students, is for the business and profession, if I am making the payment, these payment for the business and profession which is carried on in India or for the source of income which is in India, then these income which I have paid to whom? To the non-resident, I am making the payment for my business in India or for my source which is in India. So for these particular purpose I am making the payment to the non-resident, then the income of that non-resident, which income? Interest income, royalty income and FTS income of the non-resident is always deemed to accrue as in India. Always. Now this is irrelevant. Friends, you just have to see the purpose only. For which purpose that the payer. Now the payer can be any person, students. Payer of the amount can be either government of India or a person who is a resident in India or a person who can also be a non-resident. Paying to whom? To another non-resident. You also saw any example? Example I'll tell you. Marriott Group has appointed an architect firm. So Marriott Group USA has appointed primarily an architect firm also in USA. Now that architect firm which is in USA, the work was that you have to provide me an architect service for my hotel which is situated in India. So Marriott Group has an hotel in India. So therefore there is one hotel in India. For that hotel, kindly provide me an architect service. So now, who is the payer? Non-resident Marriott Group. Who is the payee? That architect non-resident. What is the nature of payment? Fees for technical service. Now in that particular context, whether this FTS income earned by the architect, whether that FTS income will it be deemed to accrue as in India? Answer is yes. Answer is yes. I'm telling you, you have to only see this much. You don't have to take it further. Huh? Further discussion is irrelevant. Now, let me ask you then a question on this particular point only. That architect firm has said to JW Marriott that, look boss, I'm a person with a 50 years experience. Now without even going to India, I can prepare the architect everything primarily of your hotel which is situated in India. So let me sit in US only. I don't want to go to India and I'm going to give you the report. The architect particular, the entire design and everything, I'm going to make it for you. So that person doesn't come in India. And while he is in USA only, he is giving the architect service to that non-resident, JW Marriott, for which JW Marriott makes a payment of fees for technical service. So whether that fees for technical service amount earned by that US architect firm, whether that income, is it deemed to accrue as in India? Is it deemed to accrue as in India? What I have told you, you have to only see the purpose of the payment. You don't have to take it any further. You don't have to see whether that architect firm, did he came in India? Did he have any physical presence in India? Did he had any branch in India? Did he rendered any service in India? All these things are irrelevant point. You just have to stick your neck on the purpose for which the payment is made. Please don't take it any further. And if the purpose is, and the purpose has to be seen from the payer perspective, who is the one who is making the payment? If the one who is making the payment, the purpose of the payment is for a business situated in India or a source which is situated in India, then the payee non-resident who is receiving interest, royalty or FTS, that payee non-resident hand, in their hand, the income will be deemed to accrue as in India. That is the only thing that you are supposed to see. I told you that you don't have to see any further. That is it. You don't have to ask a question that, sir, whether he rendered the service in India. That rendering of service was only for salary. Whether he has a business connection in India or a physical presence in India, that is only for 911, not for these sections. Not for royalty, interest and technical service. So once the purpose test is satisfied, purpose for which the payer is making the payment, if that test is satisfied, then you don't have to investigate anything further. That's exactly the point. That is exactly the point. I hope that all of you are clear with this one. Every one of you. Fine. But if you say, no, sir, the purpose of the payment was for a business which is situated outside India. So, say for example, a Taj Hotel Group, which is a resident in India, they are having some hotels outside India. For that, they have appointed a foreign architect firm to provide an architect service to that hotel unit which is situated outside India. Now, who is the payer? Resident person, that is Taj Group. What is the nature of payment? Fees for technical service. What is the purpose of the payment? The purpose of the payment was for a business which was situated outside India. Who is the payee? Non-resident architect firm. Now, whether for the non-resident architect firm, this fees for technical service received from a resident payer, whether that income will it deemed to accrue as in India for that non-resident firm? Will it deemed to accrue as in India for a non-resident firm? Answer is no. Why? Purpose has to be seen. Who is the payer? I've told you. Resident or a non-resident. Doesn't matter. Primarily, what you have to see, what was the purpose of the payment in this context. If the purpose is India, in India, accrual will also be in India of these three income. If the purpose is outside India, the accrual of these three income would also be outside India. Now, of this general principle, there is only one exception. And what is that exception? The exception, students, is of this general principle, students, there is only one exception. And what is the exception, students? The exception is if the payer happens to be government of India. Students, if the payer happens to be government of India, then irrespective of the purpose for which the government of India is making the payment of interest to the non-resident or royalty or FTS to the non-resident, it is irrespective of the purpose. That income will always be deemed to accrue as in India. So say for example, students, if the government of India is having some project in Bhutan, and for that project in Bhutan, it is say taking a loan from some foreign foreign institutions. The project is in Bhutan, which the government of India is executing. For that particular project in Bhutan, they are taking some loan from some foreign institution. And against that loan, the government of India is making the payment of interest to that foreign institution. Question therefore is whether the interest income earned by the foreign institution from government of India, will that be an income which is deemed to accrue as in India? Answer is yes. Will you check further? No, sir. What is the purpose? Purpose has to be not to be seen. This is the only exception. If the government of India is the payer, then you don't see the purpose. But if the payer happens to be a resident in India, or a payer happens to be a non-resident in India, then in that case you will check the purpose, and if the purpose is for a business or a source in India, then these three income will be deemed to accrue as in India. If the purpose is outside India, then these three income will not be said to have accrued in India. Is that point clear to all of you students? That is part A. And now coming to part B is about the assessment. Now, how do you do the assessment, students, in this context? So, students, assessment particular part of interest, royalty, and FTS, the rates are important in this context. So, just have a look, students. First, the rate for dividend and interest. We'll do the assessment in two parts. One is for the dividend and interest, and another is for the royalty and FTS. First, the dividend part. Students, what is the rate of tax? Students, be careful. There is a special rate of tax. The dividend income earned by a non-resident from an Indian company, that dividend income will be taxed at a special rate of 20%. Special rate is there of 20%. Be careful. The question is going to come now on tax liability question. 20% is the rate in this context. Now, what about the interest income, students, of the non-resident? The general rate is 20%, students. Be careful, students. The general rate is 20%. We all are aware of it. The general rate happens to be 20%. But there are special rate of 5% applicable also in some cases. I haven't seen any question in the examination yet on that 5% area. But you have to be very careful on that particular part also. In this context, students, the 5% rate is what you need to be careful on this particular. This is only for MCQ question, students. They ask this special rate of 5% on interest income in the MCQ question. Just have a look, students, over here. Read it once. 5% rate. So in a simplistic manner, students, suppose how to remember all these things. So the simple way of remembering is this, that long-term infrastructure loans or to long-term infrastructure project, if the loan has been given or bond has been issued for long-term infrastructure project, just keep that in mind. Or second one, students, is about rupee denominated bond. The second one happens to be rupee denominated bond. So either the long-term infrastructure project or through a rupee denominated bond, if the loan has been given, then on that the rate of interest happens to be 5%. That is it. 5% is the rate of interest. Okay, so it is like this. Remember like this. Dividend income. Simple word. Dividend income. What is the rate of tax? 20%. Interest income earned by the non-resident. What is the tax? 20%. But be careful, students. Over here, there is only one particular point which you have to be very careful. This point, 20% point. This one. Only one point you have to be very careful. That the loan should have been issued in foreign currency. The non-resident who is giving the loan, that loan should have been issued in foreign currency in this context. Only when the loan has been issued in foreign currency that the 20% rate would be applicable. Okay. You will say, sir, what if the loan has not been issued in foreign currency and it is not falling in this 5% category also? Then the interest income which is earned by the non-resident, at what rate it will be taxable? Supposingly, I'll give you the example also. The example where the loan is not issued in foreign currency. I'll give you the example also. The example which they are asking in the questions in the exam. But let me in fact try to get the answer first. What is the rate of tax? Supposingly the loan has not been issued in foreign currency and that loan is not falling in that 5% bracket also. Then what is the rate of tax for the interest income in this case? What is the rate of tax in this case? So the special rate is not applicable then. Because for special rate, either it should fall in that 5% bracket. 5% bracket is applicable for two things. One is the loan which is in respect of long-term infrastructure project. Either the loan is in the form of plain loan or through a bond. But it should be in respect of a long-term infrastructure project, or the loan should be in the nature of rupee denominated bond. Then it is 5%. Other than that, the other loan will have a special rate of tax of 20%. All the other loan on which the interest income is earned would be charged at the special rate of tax of 20% only if the loan has been issued in foreign currency. Only if the loan has been issued in foreign currency. What if the loan has not been issued in foreign currency then? In that case, what happens? If the loan has not been issued in foreign currency, students, in that particular case, students, in this regard, in that particular case, students, quickly, what happens? Then the interest income which is earned by the non-resident, will be taxed at the normal rate. And if that non-resident says a foreign company, if the non-resident is a foreign company, then what is the normal rate of tax for a foreign company? Don't make this mistake, huh? Don't say 40%. 40% is the old rate. Now the rate is 35%. So the normal rate of tax of the interest income would be 35%, because that is the normal rate of tax for a foreign company. Okay, so if it is not falling the special rate, the normal rate will apply. Now let me give you an example. Example of the loan on which interest income is earned. That loan is not issued in foreign currency. So students, there is very popular adjustment that is asked in your examination question. And the adjustment is like this. Be careful. And the adjustment income is like this. That the non-resident has given a technical service to a resident party. The non-resident has given a technical service to a resident party. Now, against that technical service, the consideration that has been paid by the Indian party is not by giving monetary consideration. Monetary consideration was not been given. Instead, the consideration was paid in a non-monetary form. What was the non-monetary form? The non-monetary form was that the Indian company has issued its own debentures to the foreign company. The Indian company has issued its own debentures to the foreign company. In this regard, the Indian company has issued its own debentures in foreign company. In this regard. So, if the Indian company has issued its own debentures to the foreign company, please tell me that Indian company which has issued its own debenture, the debentures would be denominated in INR. So, the loan that has been created, can I say that it is in INR? Because debenture is the loan, no? In that context. So, I am not giving you the money, I am going to give you a debenture. So, debenture becomes what? A kind of a loan, which debenture which we are going to redeem in next 10 years. That debenture will get redeemed in next 10 years. And that redemption will happen in INR. Now, in the meantime, I am going to pay you interest. So, the loan which got created in this context was in INR. And therefore, the interest income earned by the non-resident out of the debenture, which is the loan, that interest income will be taxed at what rate? Will it be taxed at the special rate of 20%? No, it will be taxed at the normal rate, which is 35%. Now here again I am repeating, students, please make it very careful. Students, here there are two considerations in my example. There were two considerations which the non-resident has received in my example. Which are the two considerations? One was a non-monetary consideration, and that was in respect of fees for technical service. So the FTS is an income, yes. That income, the consideration was received in non-monetary form, which is a debenture. So that is income number one, for which there is a separate taxability. And what is the income number two? The income number two is the interest income earned out of the debenture. That is income number two, which is separate taxability. So therefore, when you compute your total income, you will show two distinct row item. One is for FTS. How much is the amount? The value of debentures. And second row item would be the interest income, whatever the interest income that they are receiving. So there are two separate row items. Now, when you calculate your tax liability, primarily FTS will be taxed separately. Interest income will be taxed separately. And I already told you how the interest income will be taxed. Is there a special rate of tax that will be applicable? No. The normal rate of tax only will be made applicable. I hope that all of you are clear with this particular point, students. If that is the case, students, now be careful, students. This we are talking about the interest income. Dividend income earned by the non-resident from the Indian company, always 20%. Always. There are no such ifs and buts. There are no such ifs and buts, students, in this regard. Now, students, before we proceed further, there is one MCQ question which is very popular and which I think all of you are aware. They will ask you that, look, boss, the non-resident is earning dividend income. The non-resident is earning dividend income. The question that they will ask you would be, tell me, what is the rate of TDS that will be deducted? What is the rate of TDS that will be deducted? So all of you are aware, students, I think many of you are aware of the answer also, that if the non-resident is the payee, students, if the non-resident is the payee, students, then whatever is the special rate which is applicable, on that special rate you have to load further the HEC of 4%. HEC of 4%. So supposingly dividend income is my question, special rate is 20%. So what is the TDS rate? When the non-resident is the payee or the recipient, it will become 20.8. Same way, students, if this 5% is the rate of tax on the interest income, then the TDS rate would be 5% plus 4% of 5. So effective rate is whatever it be. I think 5.2. So that becomes the effective rate of TDS. So just be very careful. This is a very popular question of the MCQ. And sometimes in the total income question also, which primarily you have to be careful about it. in the total income of the question also they will say to you that look, he has received interest or received dividend from the Indian company, and they have received the dividend from the Indian company. If they have received the dividend from the Indian company, it is net of TDS. It is net of TDS. And if it is net of TDS, students, obviously, then what you have to do? In the total income, you have to put the gross amount. In the total income, you have to put the gross amount. And how are you going to put the gross amount? So, in that case, what you have received, students, is the net of TDS. So, what you have received is 79.2. Because 20.8% is the TDS. So, if the gross is 100, TDS is 20.8. So, what is the net amount received in hand? In hand, it is received is 79.2. So, that is whatever is the question that they have given you is the amount. You have to, in the total income, you have to show 100. So, do the cross multiplication, you'll get the answer. So, that becomes the amount that you have to show in your total income. And then once you calculate your tax liability, in the tax liability particular part, apply the rate of tax and then come to the solution. So sometimes in the total income question also they will say that non-resident have received dividend net of TDS. So what do you have to do? In the total income, first you have to put the gross amount, and then when we calculate tax liability, put the respective rate and then calculate the tax liability finally after adding the HEC. And sometimes students, what they give it to you, sometimes they give it to you this particular part. Where they are giving it to you, this particular part, what is that? That MCQ, only MCQ. That look boss, this has received the interest on long-term infrastructure bond. What is the TDS rate that will be applicable? So don't say 5%. Non-resident is the recipient, 5 point loading of the HEC. I hope that every one of you are clear with this one. So before you start solving the one question which has been there in this regard, just let's finish it off the assessment. Students, what is the special rate of tax of royalty and FTS? The special rate of tax of royalty and FTS, students, be careful. In this context, 20%. Earlier it was at 10%. Now it has become at 20% is the special rate of tax. 20% students happens to be the special rate of tax in respect of the royalty or the FTS income. Now, this students, royalty and FTS income, there is a special rate of 20%. There is a royalty rate of 20%, but be careful, this is applicable when 44DA, other than 44DA case. This special rate is applicable if and only if 44DA is not applicable. For royalty and FTS, the special rate of 20% is applicable if and only if 44DA is not applicable. You will say, sir, when 44DA then is applicable in this context. So in this context, students, 44DA is applicable, students. 44DA is applicable when? Indeed. Please have a look to this particular chart. The summary particular part. So students, ask the question. The question is that in pursuit, whether it is in pursuit approve agreement. Now the question is that whether that particular non-resident, does he have a PE or fixed place of profession through which he is providing his services. So if the non-resident has got a PE or a fixed place of profession in India through which the non-resident is providing the services, you have to ask this question. So if he has, so there are two things, There are two things. One is existence of P, that is one, and providing services through the P. In many of the examination questions, students, they will say that although the non-resident may have some physical presence in India, but the services for which he is receiving fees for technical service or he is receiving royalty, those services are not routed through the P in India. So if he does not have a P, or he may have a P, but the services are not connected with that P, then students, the rate of tax of that royalty and FTS would be the special rate of tax. The rate of tax of the royalty and FTS would be the special rate of tax, which is 20%. And if, students, if it is effectively connected through the P, if the non-resident has a P, point number one, and the services are also effectively connected through the P, students, then in that particular case, what we are going to say? We are going to say that the assessment will happen under 44DA, in which no special rate of tax would be applicable. In which no special rate of tax, students, will be applicable. That exactly the point. That exactly the point, students. So therefore, in this particular case, now if this is a scenario, students, if this is a scenario, in that particular case, if this is a scenario, students, in that particular case, students, what is the scene which is to be considered over here? If this is a scenario, students, in that particular case, we will say what? 44DA applicable, no special rate of 20% would be applied, which means that the normal provision would be applicable. And if normal provision is applicable, students, then what happens? Then will he be eligible for deduction of the expenditure? Yes. Please, I think all of you are aware that whenever a special rate is applicable, no deduction of any expenditure is allowed. But if the normal provision is what is applicable, then the deduction of the expenditure is allowed. But here in 44DA, there is one point that you have to be very careful, students, which is that no deduction will be given of the expenses which are not wholly and exclusively in relation to the P in India. Wholly and exclusively which is in relation to the P in India, for that we will not give any deduction. So yes, if the assessment of the royalty and FTS is under 44DA, then we give deduction of the expenditure. But which expenditure or the allowance? The expenditure or allowance which is wholly and exclusively connected with that P in India. Only for that expenditure that a deduction will be available, not for anything else. I hope that all of you are clear with this one, students. Every one of you. And that exactly is the point, students, in this regard. So let me give an example for all of you. There is a case of, students, there is a case of the head office expenditure. Many of you are aware of. Isn't it? So, some portion of the HO expenditure is getting apportioned to the Indian P. HO expenditure, some portion gets apportioned to the Indian P. Now, whether that HO expenditure, is it wholly and exclusively in relation to a P in India? Whether that HO expenditure, is it wholly and exclusively in relation to a P in India? Answer is no. And because it is not wholly and exclusively in relation to a P in India, therefore whether it will be taxable in India? Again the answer is no. Sorry, not taxable in India. Whether it will be allowed as deduction in computing the income under 44DA? No. Another very popular adjustment they give you, that the Indian P has given the reimbursement, has made a reimbursement to the HO. That reimbursement was in respect of the P expenditure. So P has incurred some expenditure. Initially, the payment was made by the HO for that expenditure. Subsequently, the P has made the reimbursement to the HO. So whether that reimbursement will that be allowed as deduction? Answer is yes. That reimbursement will be allowed as deduction in this regard. And that exactly is the point, truth. That exactly is the point. That will be allowed as deduction. Why it will be allowed as deduction? Because the expenditure was exclusively for the P in India. Now I hope that every one of you are clear with this point. In this context, all of you. This is how the things has to be looked upon. Now students, what you are going to do now immediately. Be careful, this question is expected on your examination, and therefore I would want all of you in your MTP. Please show me the solution immediately after this. There is one more variety of question which we will solve in the class, but first is the MTP particular part. I want all of you to MTP page number 16. Page 16. Sorry, page 17 of your MTP. It is C point. In fact, the name of the question also I'll just tell you. 17 and 18 and page number 18. The name of the question is, I think, Strawberry Limited. Strawberry Limited. This also you are going to solve now. Two questions immediately you are going to solve. One is that question which we have already discussed. This question now I want all of you to solve it and just give me a solution. Now please pay attention. The marks allocated is only 6 marks. And I don't know for what is the marks which was there for that Flix company which we discussed initially. Ideally, I think that it should be also for 6 to 7 marks, not more than that. So in all, it is for the question that you're going to solve is for 15 marks. Students, I want when you do the solution as if you are doing in the examination. I want also for each solution, I want to know how much time you have taken. Please, while you give your screenshot, you will also write this much time you have taken in this case. So please set like an examination condition for that half an hour period, whatever it is. And I need also to know what is the time that you have taken. Because as I told you originally, the paper, it becomes difficult for all of you to complete this particular paper in first place. Very difficult in this context. Not impossible, but difficult. So what you write, how much you write is also important. The content has to be impeccable in this context. So that is one thing I need to know very carefully. So please also let me know the time. One more particular point, students, which has been there in this strawberry question, there is one thing of dividend on GDR. You will say, sir, what is the rate of tax of GDR? Right? Take the rate of tax as 10%. This will come in one of our next class, family dividend on GDR. So you will take as 10%. Dividend on GDR. Particular point. So students, that is the point, students, which you will just consider it. And on that basis, please, other dividend income, dividend from Indian company, what is the rate? Dividend from Indian company, what is the rate? 20%. Special rate. Dividend from GDR, 10%. Which section I'll let you know later on in this context. So this is the point, students, which has been there. Those two questions, I need a solution immediately. And after this, students, I'm giving to you a DTAA theory session, a small theory session on DTAA. Go through that, importantly. And then we'll start solving the RTP question and MTP question, because DTAA is the real game. There are no ifs and buts on DTAA. It is going to come in the examination. Practical question. And there are a lot of varieties in that. In the DTAA question. Those variety needs to be known to us. So do ensure to run through the theoretical question one, theoretical part, and then students after that, immediately, we'll have a practical session on this particular part, on DTAA. You then students, immediately students solve this two question. Page number I have already told you in this context. Okay, so therefore the first question Didn't I told you the page number? The first question, page number, Flix Limited, indirect transfer, page 31. So page 31 and page 17 and 18. Okay? Of your MTP. Just go through this thing, this context. You will just go through it and just let me know. See you then, students.